So again, thank you, panelists, for the great conversation. I really want to make sure that we are prepared for this next panel and great discussion. For those who are just joining, 8th Annual Hispanic Heritage Foundation Investor Forum, welcome. And up next, we have the Evolution of the Private Markets panel, sponsored by Barnes and Thornburg, LLC. Joining the panel, private market investors will discuss the investing landscape as institutional investors continue to allocate more assets to the private equity and credit markets. Moderating the panel is a good friend. We've had drinks in the very first event I participated. So Anthony, welcome back. Anthony Arnold, who's a partner at Barnes and Thornburg LLC. So take it away, Anthony, and nice to see you.
Thank you, Martha. Great to see you. I'm hopeful we can do this in person next year again, so we can follow it with some delicious margaritas and good discussion in Oakland. That was a wonderful experience, and I'm hopeful we can get back there again soon. Yes. So far, I mean, it's been a great morning. I've learned a lot. I actually listened to all the panels and actually have a couple of strands and themes that I think are going to be consistent with our panel, which is the evolution of the private markets. We have an all-star lineup for you today. I'll go ahead and make quick introductions and then we can jump right in. So first we have Christine Kenna, who's a partner at Ignia. We have Marjorie Lopez, who's Vice President, RX3 Growth Partners. Cheryl Mejia, who's Managing Partner at Steward Asset Management. Nate Mejias, who's Vice President at Clear Lake Capital Group. Frank Mora, who's a partner at HCAP Partners. And Lou Zhang, who's a founder and managing partner at Fusion Fund. I think you guys will find lots of great insights from this group. I do have a few questions, but obviously, as Martha mentioned, to the extent there are questions from the audience, feel free to put those into the chat box and we'll make sure they get floated up to the panelists. So the first question I have is kind of a general overview of what we're seeing in the private markets today. I know 2020 was an anomalous year for many different asset classes, and I think private markets are no exception. They seem to have rebounded in Q4 of 2021 and normalized even further in Q4 of 2020 and Q1 of 2021. Seems to continue that trend of normalization with valuations evening out slightly. But it seems like there's a lot of momentum heading into 2021, and I wanted to kind of poll the group to see what their thoughts were on whether that momentum will continue or whether we'll see any changes coming into the second half of this year. So I'm going to go ahead and direct that question initially, but obviously any of the panelists who want to speak up can do so. Why don't we start with Marjorie?
Thanks, Anthony, and thank you, Hispanic Heritage Foundation, for inviting me here today. Really excited to join such an impressive and diverse group of panelists. You know, we're seeing that our pipeline has not slowed down from 4Q to 1Q. We're really excited about what we're seeing in the market. But as you mentioned, valuations have also remained high. And, you know, we're seeing a lot of optimism and momentum from the swift vaccine rollout in 1Q, and you're seeing consumer spending rebounding really nicely, you know, from that optimism, and consumer savings that have been compiled during the pandemic have helped fuel that growth in consumption. And we're really seeing the data points that consumers are willing to spend more this year. So definitely that's kind of going into the second half of 2021, we're optimistic. I think just some things to kind of watch out for and things that we're looking at very closely is just the risk of, you know, potential inflation looming, you know, rising input costs and in certain sectors, and just making sure that our companies can sustain those margins as we're seeing, you know, some input price increases. And I'll open it up to the other panelists as well to see their thoughts on 2021.
Excellent. Thank you, Marjorie. I think next we can go to Cheryl to see if there's anything in what Marjorie said that you would agree with or want to expound on, or your thoughts on what the rest of 2021 might look like.
Great. Thanks, Anthony. Thanks, Marjorie. Great comments. I definitely have seen a lot of this momentum carry us to larger deal sizes. And so We think of the world as large buyouts and small buyouts primarily in our largest universe, and we anchor new small buyout managers. So we're looking at sectors, which sectors are still have reasonable valuations, and which ones are worth the extra reach for the valuation. And I still see an enormous amount of inefficiency in the lower middle market as deal sizes have gotten bigger. And so if you are keeping your deal sizes smaller, I think that you can really serve your investors well in this sort of K-shaped recovery. You're seeing that just like Zoom we're using today, there's just new service paradigms that some smaller companies with currently small market share really can make enormous leaps. And of course, large buyouts have done very, very well in recent years, but they use more leverage, and that leverage has been very cheap. So as that changes, I think the investors, I'm hearing from a number of CIOs that small buyout allocations are on the list of priorities. Small buyouts and growth equity and venture.
Interesting. Yeah, and on the leverage point, I would love to hear from Frank more at HCAP, who I know has been focused on mezz, but is also moving into equity investments. What your thoughts are in terms of both the buyout market, but also the mezz debt market as we're progressing into the second half of 2021.
Yeah, I agree with Cheryl's comments on the quality of transactions. The size is getting larger, pressure on lenders to put more money to work to allow for some of those larger transactions. What we've seen is really a lot of there was a flight to quality that back in Q4 where people were paying really high multiples, but only for the A type credits. While there was uncertainty, some of the maybe B credits were struggling to get transactions done. I think as things normalize now, we're starting to see a lot more of that start to gain traction in the market. We also expect the rest of the year to be strong from a deal flow standpoint because of potential tax implications or the perceived sentiment from all business owners that there may be tax implications if they delay their transactions. So folks who may have been considering more of a growth round are now starting to evaluate potential full exits or a larger transaction in order to try to get ahead of any potential tax changes.
Mm-hmm. Yep, and I guess next we'll go to Nate, just picking up on that same theme. I know you guys play also in the middle market, a little bit maybe on the upper end of the middle market, but are you guys seeing similar things to what Frank and Cheryl and Marjorie may have noticed?
Yeah, no doubt. Great comments across the board. Happy to be here. Yeah, we're seeing some pretty tremendous volume. A lot of folks who particularly are benefits of inflation are selling their businesses today, and I expect that in 2021 we'll see continued momentum of whether that's on the industrials or consumer or tech side where we focus, be the topic du jour. And look, we're trying to be very cautious about where we buy assets and where we have angles around that. But it's certainly a red hot M&A market right now. We're seeing a lot of folks go sell assets given the valuations and given a lot of businesses are seeing very interesting little COVID bumps. So that's the observation I would make.
Yep. And to round out the analysis, moving a little bit earlier in the life cycle, Christine, your thoughts on this particular question about what we can expect in the second half of 2021?
Yeah, it's so interesting because, I focus on early stage venture investing. So I'm, listening to all of these other opinions, I could say they absolutely apply to what I'm looking at fundamentally day to day. But really, when I say, what do I expect for the rest of this year? It's going to continue to be very, very strong because our pipeline has been strong and the types of businesses that we are investing in, technology enabled, that have just really benefited and boomed through the COVID experience of digital commerce, fintech companies. I mean, the fundamental core businesses and assets are extremely strong. So we continue to see that growth, yes, in valuations. I think what we saw at the end of last year is only the best companies were getting funding, whereas now I think people are being a little bit less cautious, or they're aware that these companies are going to thrive. And so I think we're going to see record-breaking deals again, as we did at the beginning of this year.
Excellent. And last but not least, Lou, I know I've been reading the news about some of your portcos having nice exits recently. So anything in particular you want to share on this topic?
Yes, happy to. 100% agree with what Christine mentioned about earlier stage. We focus on earlier stage as well, just more on the B2B side, digital transformation, enterprise industry, and healthcare. These are another two trends got pushed dramatically by the COVID. So definitely huge amount of capital kind of rush into the sector for investment. And we definitely see a rise of the valuation even at a super earlier stage. For example, right before this panel, I was in the call with one of my associates. One deal what we're looking at is a deep tech company, pre-revenue, pre-MVP. They got a term sheet was 50 million valuation, 50. I think the reason of this high valuation is also because, as like Cheryl mentioned, in the kind of growth stage, the valuation is so high already. So lots of the VC firm, our capital used to focus on growth and late stage. Found it's hard to justify the potential multiple. So they try to allocate more capital to earlier stage. I saw several deals recently, especially in digital health, that the VC jumping to the same round with us as a firm like Andreessen and Sequoia. And they are trying to put the check size like $5 million to $8 million to a C stage deal. So definitely in general, there's an inflation of valuation. There's a definitely concern whether too much capital would be good or bad for the founders. I'm a former entrepreneur, used to run my own company. I'm a believer that, that is better than perfect. It's always better to have sufficient capital, but not too much. So we've been talking with our founders and also the company we're working with to be cautious and be rational with this like super hot market. But on the other side, I think in general, it's good that so much capital are interested in earlier stage, especially the deep tech sector and the healthcare sector. I think after COVID, people start to realize there are certain type of technology would require relative longer period of time for R&D and slightly more capital to invest in the earlier stage before the commercialization. And with some more capital jump into this space to fund the next generation leader of these founders and innovations. So I agree with Christine. I'm really looking forward to the rest of the year. And we're also trying to be more competitive. We're trying to, take the lead position when kind of competing against all this mega fund from the Sun Hill for the C stage deal.
Interesting. Yeah, that actually dovetails well with my next question, which is how do you source deals in an environment like this where there are, kind of exorbitant valuations, lots of competition for deals? Do you want to kind of address how you're finding good deals? Whether there are areas that have dried up in terms of sources for deals, what that sourcing looks like?
Yes, I think we all kind of do similar things with exchanging deal flow. We have our own deal flow network. I think one network we had kind of works very well for us in the past 1 year is a repeating successful founder community. Because not only me, other partners in my team, we're all former entrepreneurs. So we kind of maintain a network of all the serial entrepreneurs who've been observing the market, finding the best timing to launch their next business. And luckily we found last year, all the 7 companies we did, the new investment we did, the founder all had a profile as a repeating successful founder. So that's also a very strong signal for us to say that, okay, this is a good market timing for early stage investment. So we continue to put more efforts to kind of really engage with them early on before they're thinking about launching company, before they're thinking about doing a funding round. Then, we could put in the check probably earlier and then justify the valuation with decent ownership. Another thing we found is all this experienced founder, they're more kind of cautious in terms of which type of partner to work with at earlier stage. And also what is the right valuation to take without having consequences of, potential down round in the Series A, B stage. So we really like working with them. I would say that's the most efficient one we found. Another approach we take, probably some other VCs start to do it. We've been doing that for many years, is using data analysis approach. So build a very strong database, contain lots of the information about potential founders, potential trend, key influencer in certain sector we focus, and run the algorithm to gather information from all these public resources to identify the stealth mode founder, be able to reach out to them early on before they think about fundraising.
Interesting. And I guess we can just go reverse order here. So Christine, you want to tackle that one as well?
Yeah, I don't think nothing has really changed about the way that we source these deals given the hot market and the competition, because this is really a relationship industry where reputations are built over many, many years. And so the best sources of deals are our founders and are the people that know us and our co-investors that work with us. So we continue to rely on that network so that we are the fund that is called for what we do best. We invest with great conviction. We are very sector focused and geography focused investors. And so that what we're doing now is just continuing to do more of what we do well. And so I don't think there isn't anything that we've changed, but it's just, really trying to follow up and being the fund of choice for those great founders.
Okay, interesting. Nate, any thoughts on deal sourcing and whether it's changed in the last 12 to 18 months?
Yeah, look, it's largely the same for us. I think where we try to differentiate is just through our strategy. So we'll, we make investments in secondary, right? So we'll buy debt, buy equity. So it's really for us, to Christine's point, being very, very focused on specific sectors. So we've tracked companies for the better part of since Clear Lake's been founded, and even prior to that. And so we kind of, once they're ready for sale, the things we're looking at are typically on the private equity side going to be banked, right? They're larger assets. And so it's really picking the right spot, having the angles, and having kind of a good operating council and executives around the table that we know well to go differentiate ourselves and as the preferred buyer, and hopefully win or find value where other folks aren't finding similar value. So that's where we try to source, and we find that being a credit investors, private equity, distress for control, having all those different touch points in different parts of the capital structure, and having the same team evaluating all of that stuff internally at Clear Lake at least helps us source a lot of our angles in our deals.
Interesting. Frank, you got thoughts on this one?
No, it mirrors a lot of what's been said. I think in our case, being a debt investor, we're not seeing or we're not as subject to the valuation pressures that could impact other folks. But, for us in particular, the geographic focus has always been there for HCAP, kind of our Western U.S. focus. So that has helped. But for this most recent fund, we started specializing really in healthcare, tech, and just being able to have that specialization, with I think both Christine and Nate spoke to, it has helped us, because people hear, hey, HCAP did this deal, or they see a press release, and then we start getting more and more deals and deal sources finding that, hey, this is a deal we should be showing HCAP. So that specialization has definitely helped us continue to see quality deal flow.
Interesting. And I think we'll skip Cheryl, since she plays in a little bit of different part of the market, and go to Marjorie on the deal sourcing, and then move on to another topic.
Yeah, no, great topics all around, and kind of just echoing what the panelists have all said for us. So we are a consumer-focused influencer fund, and the specialization has really helped us with sourcing. We also get some deal flow as well from our influencers. So we have about 24 of kind of celebrity professional athletes that are LPs in the fund. So some of the sourcing comes from that as well as some of our founders. But the process hasn't changed, but we remain very disciplined as valuations are really high, and just looking for differentiated companies within the consumer sector in attractive categories that we know that we can add value to. So, even if there is a re-rating of the market at exit, you will still get strong returns from equity appreciation by, finding and looking at these companies where you can add value in these attractive categories. So that's how we view sourcing.
Okay, excellent. So I think there are a few long-term trends that we've kind of identified in preparation for the panel. I think one that I want Cheryl to address first, since she didn't get a chance on the deal sourcing one, is essentially the allocation question. We heard in the last panel, the CIO panel, that much more capital is moving to the private markets. Stacey Olivares from CalPERS indicated, it's that trend had already been starting in, the kind of late teens, and is picking up in the 20s. Wanted to ask Cheryl, how do you see the current fundraising environment for private funds? And then how can fund managers distinguish themselves in this environment?
Yeah, absolutely. Thank you. Well, it's interesting because I started 25 plus years ago in public equities, and I for just a few number of years, and I did make my way to the private markets. And I have to say that the contrast to the 1990s, how we thought about small cap and international stocks as the new frontier. I think that the private markets have gained in efficiency and effect, and it's still illiquid, but it's still, companies are staying private longer because they can, and the capital's there. So if you have strong recurring cash flows, you will find a larger and larger buyer. So I think that capacity and that evolution, I think you're seeing come to fruition. It's an enormous universe. I think people forget that just the middle market, which is not the smallest company, the millions of small companies, or the, 5,000 large private companies, or maybe a little bit less than that. But there are only 5,000 public companies, but there are 200,000 middle market companies. And so it's this enormous universe of, many of them are high cash flow earning. Some of them are much older, wouldn't be suitable for venture. And so there's a increasing transaction volume in that market. So the private markets there we're just seeing more and more vehicles. And now with people being able to access these vehicles with their 401ks and IRA vehicles, we're going to find even more capital flowing in. But it's been a very, it's still a very attractive market with many, many deals transacting under 10 times. And but I'll leave some of the other topics around this evolution. I've talked about the long-term evolution, but I see it as a sort of a hiding in plain sight sort of opportunity, because it's your local family-owned business. And if we can make sure that the capital, gets capital, well, the PPP loans was targeted there, but that was just, short-term credit. We really need the equity capital to get to these business owners that we care so much about in our community.
Yeah, absolutely. So I think, obviously, you touched on another kind of long-term trend, which is that companies are staying private longer, GPs are staying in investments longer. I think that does in and of itself kind of have a feedback loop with the fundraising environment. Anyone want to address that trend? I know on the fundraising side, obviously, I know a few of the folks actually on the panel are in fundraising mode, so I want to exempt them from this question to not run afoul of any securities laws, putting my lawyer hat on. But if there's anyone else who wants to address either the fundraising environment question or the GP hold period and the company the company staying private question, want to open it up to the panelists to touch on those topics.
Yeah. I'd like to just make a comment in general about the fundraising as we see, and again, I'm on the GP side, so on the total side of the fundraising spectrum. If I think about GPs that have been fundraising, what has been most shocking to me, and we've been talking about the effects of COVID, but have been on the effects of COVID for female managers as well. So we're just beginning to see the stats come out and actually get results where they see that while they've had record fundraising years, not only for venture funds, but also for venture-backed businesses. When they actually look at funds that are led by women, those numbers have gone down radically. From 2017, they were 10% of the funds that were led by women received funding, whereas now they're coming out with something around 3%. Right. And the same thing is happening with the venture-backed companies led by women. So this is what I see is sort of the greatest tragedy, I think, of what we've seen come out of this period of time. I also see that the established funds have had great success fundraising, but emerging manager funds have been struggling greatly.
I see the same thing, Anthony. It's I think it was more easy to re-up in your allocations and then do something new, especially outside of channels that you were already naturally in. And so there is a affinity bias when you have to do difficult transactions to do them with people who are more familiar to you, and that's something we need to continually correct. And I just I'll let other people comment, but it's great comment, Christine. I think that it was Christine, right? You're not popping up on my screen, so
yes, Christine.
Yeah, brilliant. Really, you're absolutely right, and it's we anchor newly forming firms, and we're seeing not many moving without our capital availability, not many moving off the pipeline with other anchors. So we feel like we opened the front door. About 40 or 50 managers in our pipeline have a diverse or a female leader, and we're just so thrilled to be able to provide that routine capital. But it's hard to get a startup and also build new relationships with LPs in this environment.
Yeah. Why do you think that is? I mean, institutional investors aren't necessarily decreasing their emerging manager mandates, right? Is it just having kind of difficulty presenting a track record, or what's the kind of hang up on the emerging manager? Also kind of including the female-led fund category there as well.
I'll just throw out one idea: is in-person meetings. I think to build relationships and to get capital allocations, you need to have in-person meetings. You need to that's a comfort zone. But I'll welcome other people's thoughts to what this is, because I don't think it's well documented. I think we're just observing it, as Christine said. We're just seeing the numbers come out.
I'll chime in a little on that one. I think that's right. I think part of the issue is a lot of times, investors want to take time to get to know a fund, get to know it over time, right? But when they're ready to maybe hit the market or go fundraise, you want that in-person meeting, especially with a first-time LP. So although their allocations may be growing for emerging managers, the inability over the last year to have those in-person meetings, I think, has hurt folks who may be in the market, because it's tough to build those relationships for a first time. If you've got existing investors, that's not a problem, but for new investors, I see that as a potential issue.
Got it. Anyone else have thoughts on this topic?
Well, we'll follow the numbers. PitchBook does a great job of reporting on these numbers. I follow their reports, but I think we'll hopefully get back. We're going to follow that health trajectory, but I would encourage all, Fund 1 and Fund 2 investors to get as many in-person meetings as you can, or book them into the fall. And I think there's a number of live events coming up in the fall, and definitely try and get to them if you feel comfortable.
Yeah, go ahead. Yeah, go ahead, Christine.
I was going to comment on what I think one of the challenges are, for emerging managers. And then, as you mentioned, the fact that there are longer holding periods of times before realizing exits. As an emerging manager myself, I can give you, a real life case is that while we have some phenomenal performance in our first fund, and we can show all of our TVPIs, or sort of all of our returns, really what new investors are looking for are for the actual, return to capital. They want to see our TVPI numbers. And so it's interesting as we're getting this pressure where some of even our current institutional LPs, so pension funds, have said to us that, well, we want to see the capital returned before we re-up your next fund. So while we have those secondary positions available and we have the offers on the table, it really does not behoove our, for maximizing our returns, we should not sell our positions in the secondary market now, although it would benefit our next fund. I see. So we have this sort of conflict of interest, whereas what's best for the long term for us raising our next fund quickly, yet our LP investors are actually pressuring us to return the capital faster, right? So that's an interesting dynamic that I'm seeing happen in real life.
Yeah, that's interesting tension. And I guess, obviously the part of it is no one could have predicted this market, and some of the trends are reacting to the market. You sign a limited partnership agreement with a certain hold period, and things change. Obviously, after you sign the document, things can change, and maybe I think that could be part of playing into it, is setting the expectations up front about how long the hold periods are going to last. I wanted to get Nate in on the holding period issue as well, because I know Clearlake's been doing some interesting things in terms of moving individual assets out of funds into single funds, or kind of additional vehicles that are being, allowing for a longer holding period. And I wanted to kind of see if that was something you thought was a long-term trend, or just kind of something that's being done now to address kind of more acute issues related to, particular investments.
Yeah, for sure. Look, it's certainly a function of the market and the availability of capital, but it's also a function of, we've been wanting to own some of these assets for a long, long time, and we've only owned them for a little while. And, we think there's tons of runway ahead of them. So you've seen us do, I think, now 4 or 5, single asset vehicles where we sold portfolio companies to still Clearlake controlled vehicles with good partners of ours from the limited partner community. And look, I think the reason for that is, one, we want to take advantage of the valuations where they are today, and 2, it certainly is cleaner than taking a company public, for example, which takes a long time, isn't a real exit, or we just really like the business and want to continue to see returns from it in those funds, because it's really hard to find the right assets. So that's certainly been part of it. And look, to the point earlier about just assets staying private longer, it's really tough, right? Nobody we buy a business from who's a sponsor wants to take a company public. Even the SPAC dynamics, we just took a company public through a SPAC. We signed the deal in December. We're not going to close it till next week. It's painful. It's hard. It's and it's not a real quote unquote exit. So I'm not surprised that we're seeing a lot of companies just stay private. As managers have gotten bigger too, right? So some of these bigger managers can continue to buy assets, and you've even seen managers buy assets for the second or sometimes third time in new funds. So it's fascinating.
Yep. Absolutely. Anyone else want to address this trend of the holding period or staying private longer?
I'll go back to Marjorie's point just for a moment about the pressure when you're raising Fund 2 to realize them in Fund 1. I don't know if it was Fund 1 and Fund 2 for you, Marjorie, but I think that there's a skepticism among LPs about markups and unrealized gains. They really want to see the round trip before they will invest in Fund 2. It should be a couple of deals. So I think that we always encourage when we're giving our anchor capital into that first institutional fund, we really want to see a pipeline that's going to be deployed very quickly. So we know that in 3.5 years, there will be pressure for at least one or two, at least partial exits, or some realizations, so that to raise the capital for Fund 2. And there's often a constraint with investors in Fund 2 or the next fund to see some realizations to make sure the valuations are solid as stated, but also just that the machine's working. So I think all the money back would be a little bit of a high bar, but I usually say a minimum of 2 is where everyone's sweet spot is. That's my historic thought, but maybe it's changing. I don't know if anyone else has opinions on that.
Interesting. Yeah, Margie, I think your name was invoked. So do you have any thoughts on that issue?
Yeah, no, that's spot on. I think that I think of it too as it's just adding to what Nate said about kind of the IPO and the SPAC game and just exiting for the sake of exiting. Even the SPAC landscape is changing right now, given the new introduction of new legislation that's going on. And it's like you have to have the right infrastructure in place for a company to be a successful IPO, and just exiting for the sake of exiting. It's not the right time. I think of it as, when we talk to these consumer brands and they really want to get to Target, or they really want to increase distribution at all these retailers, it's like, well, can you support the retailer? Do you have the velocities to succeed there? So sometimes the right answer is saying no to the Target or saying no to the SPAC at that time.
Right. And I can see, as private managers, you spend a lot of time building your thesis, getting this thing operationally where you want it to be, building the right management team, and then having to flip it because the fund's term is expiring or something sounds a little bit premature, possibly. So I'm wondering, and I guess we can go to Lou and Christine on this first, since it is impacting kind of up and down the spectrum, whether this trend of holding for longer impacts your investment strategy at the outset, whether kind of the idea that maybe, you're going to be in this for a little bit longer without seeing a liquidity event as soon as may have been more typical, whether that's impacting the investment strategy and informing what you're deciding to invest in or not.
Yeah, so I first want to echo what Cheryl mentioned about, investor put money into emerging manager before. One is in DPI. We actually got similar feedback when we talked with the institutional investor last year before we actually launched a new fund. I think I understand the rationale of this concern because there are too much capital concentrated on the so-called top performing companies. So the valuation was crazy high, not necessarily really based on the foundation of the revenue growth. So there's lots of concern about whether valuation could be justified when the exit happened. So in Q1 this year, that's when we launched Fund 3 officially. That's also when we already had, as you mentioned earlier, had a couple exits in the past 12 months, had very clear pipeline for IPO exit in the next 12 months. That's when basically the DPI is very clear and also could justify the IRR number. And meanwhile, we also present to the LP, not only just the valuation metrics, but also the revenue growth metrics in the past 1 year across the fund, across different portfolio company. I think that number resonates with LP better and then really help justify whether this IR number and the DPI could be really realized in the next couple of months. So I think that's definitely could be challenging, but also meanwhile, I think there's some kind of reasonable rational reason why LP asks for that specific numbers before putting in capital. And to go back to your questions, definitely we see this companies staying private much longer, which means for earlier stage fund, typically we're thinking about 7-10 years fund term, we'll start to seeing potential exits starting from year 5, year 6. Now we saw companies stay private for longer, then we also need to prepare in advance, like how many fund term we need to have and how we really make sure we have the exit in the year 7 to year 10. So a couple of things we did start to kind of adjust the things, I would say, since 2019. First is compare with my previous fund one. Starting from 2017, 2018, my fund two, we moved from super early stage to the stage that when the company close to the commercialization. So right before the turning point, that's when we put in bigger check. And then after putting bigger check, then they could achieve a couple $1 million revenue within a year. Then go from there, we're kind of see a clear path to the potential exit. Another thing we did is we put together a CXO network. As you mentioned, as also other panelists mentioned, merger acquisition being super active. And for the sector refocus, enterprise tech and healthcare tech, I would say 80% of companies gonna exit through merger acquisition route. So we put together this CXO community. They're all executives from global 1,000 companies, and they're the one making the decision on, push internal digital transformation, potential integrate new company into their corporate. And they not necessarily really do a comprehensive analysis on all the market players to choose the best one to do the merger acquisition. They want to work with someone they trust and have very strong strategic alignment. So we start to kind of put that in place, and we have couple merger acquisition exit actually was the members in our CXO network, and not only put them under the radar, but also the whole negotiation process went smoothly. Then we could facilitate better merger acquisition exit for our investment. So this is something we kind of start doing really based on this trend of companies staying private longer. But for IPO pipeline, I think SPAC is definitely some kind of a game changer. We will also have company doing public listings through SPAC this year. But in general, we're pretty cautious about it. We still want company to keep that in mind. SPAC is another option for potential public listing. But if you're IPO ready, go with the IPO route.
Yep. I've heard that advice as well. So, okay, great. I think we'll change gears unless anyone else has anything they want to add on this particular topic.
Sorry, go ahead, Christine.
I was going to comment how things have changed for us with these longer periods of investment time is that we raised an opportunity fund because companies kept raising more and more rounds and we ran out of capital from that initial fund, and that was not our expectation or plan. And so that's been something that's changed, and it's a great investment vehicle, right? But it's something that we originally had not planned. We had to adjust and create this for those later rounds.
And the only thing I was going to add, Anthony, I think for us, because we play on the smaller end of the middle market, we're probably seeing companies, and while the companies are staying private longer, our layer of capital seems to be used a lot as a kind of step stool, right, to get from A to B. So our holding periods have actually been really short in some cases, and we haven't seen. I guess it's a good thing. We haven't had the issue of having to find, well, we always have a couple stragglers and we look at secondaries potentially for those. For the bulk of our portfolio, we've seen shorter holding period returns, but it is because there is so much capital at the layer above that's coming down a market a little bit and hungry for quality credits that we're seeing at least our holding periods shorten a little bit.
Interesting. Yeah, I think that that's certainly a market trend, I think, and good to note. So one other kind of aspect, it feeds into this idea of, competition for good investments, deal sourcing, but also potential co-investment opportunities is the role of family offices and independent sponsors. I heard someone earlier today call them a kind of a separate asset class, right? They're not really private equity funds. They're not true funds, but they are players in the market that are becoming much more active and much more prevalent in terms of deal volume. And I wanted to kind of get a sense from the group as to, how you see, your fund's relationship with those market participants, whether they're potentially good co-investors, whether you compete for them on deals, and essentially what you kind of see down the road in terms of the independent sponsor and family office role. Not to clump them together. I know there's a huge variety in terms of the universe of family offices and independent sponsors, but for purposes of a 1 hour panel, will give me some leeway in terms of clumping them together. But I think, I wanted to kind of get a sense from the group as to how they feel about this trend, in particular, independent sponsors. And I guess we can start kind of going back up to the top with Marjorie on that one.
Yeah, sure. So looking at it, so we only do consumer. So looking at the family offices that are active in that space, we have seen, several of them kind of start to lead more deals as they're trying to deploy capital and make bigger checks. I'd say, we see them as a good source of deal flow for us, and we don't see them. It's more collaborative, our relationship with family offices and our family offices LPs. I'll say that our strategy, as I mentioned, we're a consumer-focused influencer fund. So our strategy is complementary, because we try to add value to our companies by activating our influencer base. So the 24 of celebrity, professional athletes, influencer LPs that I mentioned, because they're a true equity partner in those companies. So they're investors in those companies for the long run. So I think our strategy is more kind of complementary with them. So it's not as competitive, but curious to hear what the other panelists, relationship is with the family offices as they've become more active in the space.
Anthony, maybe I'll jump in with some next comments on. So I think of the independent sponsors, there's just a breadth of talent there. And, to remain and be a successful independent sponsor, to actually source deals and then find the capital for those deals. So be a strategic, importance to, the companies they're buying, which is often required because the companies often take a risk in that they'll get the capital. You can find some amazing talent. Some amazing talent that I think, at some point might want to come to us or some of our competitors and launch a fund. On the other hand, it's hard to lure them away into fund land because they can make better economics deal by deal and not have to pool their deals. So it's a yin and yang. On the other hand, I see some industries, the competition's so great for some certain sizes of deal transactions that they need a fund and they need committed capital in order to secure the deal. So it really depends on the sector and subsector you're transacting in. But family offices and are often play an important role because they often pair up with independent sponsors to do individual deals, and those relationships can go on and on, deal after deal. So it can feel they can tie together and actually de-risk each other. So it's can be a wonderful way to go. Although for individual investors and family offices that are just making new strategic investor or independent sponsor relationships, it's a very treacherous universe. Like there are great ones and there are not so great ones. So it's a little bit of a wider range of opportunities than in small buyout or growth equity or venture funds.
Okay, great. Yeah, we'll go to Frank and Nate next on this one, and then same question with a different wrinkle for Lou and Christine after we hear from Frank and then Nate.
So yeah, for us, the independent sponsors is we basically make the distinction of sponsors that are bringing either capital or some kind of cash to the table versus cash. So they don't have to be funded sponsors, but for us, that distinction becomes important because as a lender, we're not staffed to operate these businesses. So if we have a sponsor that if things get a little sideways, it's not tied economically to making it work and just turns over and hands us the keys, that's going to be a problem for us. So for that reason, it's been a challenge. And to Cheryl's point, there's some great ones out there. There's others that are maybe not so good, and it's hard for us to kind of distinguish. So we try to make that distinction and make sure that we are as aligned as possible to the sponsors if we're going to consider working with them on a transaction. Otherwise, it tends to be maybe more of a competitor because sometimes we'll be bidding potentially against them on some transactions. But again, it's a little bit family offices. We do not see a lot in our space. When we do see them, to Cheryl's point, they're typically tied to an independent sponsor or they're helping fund that. We're happy to work with family offices as co-investors in any of our transactions.
Got it.
Yeah, look, I'd echo a lot of the same. To Cheryl's point, lots of great talent in the kind of independent sponsor community. We've partnered with some folks. We found some good deals from folks that we've met through those networks. I would say like the ultimate independent sponsor right now is that's competitive with us is these SPACs, right? They're raising capital, but they don't really have capital until a pipe investor kind of prices it. So we do find that to be kind of competitive, right? It's hard to compete with some of the SPACs on when we're purchasing stuff. And then as far as family offices are concerned, you know, we do look at a lot of deals with family offices. We try to look at a lot of interesting assets through folks that we know from an operating perspective that maybe have family offices or otherwise, and it's been kind of a good cycle of deal flow for us.
Got it. And the extra wrinkle for you, Lou and Christine, is kind of the role of non-U.S. LPs, obviously including family offices and potentially independent sponsors. I think among the group, you most likely have the most experience with non-U.S. LPs. Want to understand whether that sort of relationship has evolved over the last 12 to 18 months, and obviously were there any special considerations in dealing with non-U.S. LPs in your experience?
Yeah, so first with family offices, I think I kind of agree with what Nate mentioned about the strategy. We also work closely with we have some family offices that are LP. We kind of selectively working with the one have a strong strategic angle with the sector we focus on investing. So not only they become an LP of our fund, they also could become another pool of the capital we could leverage for late stage investment. As an early stage investor, we definitely had pro rata rights across all this for subsequent funding round. And now pro rata capital mainly focus on Series A, B stage. So starting from B stage, that's when we proactively share our pro rata rights with the family offices. So it's kind of win-win situation because they trust us. So they don't necessarily need to do another round of complicated due diligence. So super efficient decision-making process. And for founder, as a fusion fund, we could leverage more than the $100 million fund size we have to put in more capital support a company even till the pre-IPO stage. We had a couple deals. We help our LP putting money, especially family office LP last year for the pre-IPO stage. And in terms of international LP, we have some international LP from Southeast Asia. I would say initially when I started working with them back in 2017, there's some kind of I would say they probably are not as knowledgeable as US institution LP really understand the life cycle of early stage VC. But the good thing is typically the family are super resourceful, and also they could leverage lots of kind of large corporate locally. If we have any company want to expand into that region, you know, the integration is the right away. You know, they have a different decision-making process compared with the family in United States. So that's the benefit we have in that. But on the other side, I think our kind of a lesson learned and also experience with them is really had enough communication before they make the commitment, because they tend to make very quick commitment, but we try to make sure we, no matter educate them, I'll provide enough information background to align the expectation and also make sure they really understand the life cycle of especially the tech and healthcare investment, and also understand the ecosystem in Silicon Valley. I think since then, at least so far, the couple international LP we have, they understand the market very well. We also kind of become their I would call it like an unofficial consultant when they try to allocate more capital into the other type of alternative asset manager in the United States.
Mm-hmm. You become the gatekeeper, so to speak. That's interesting.
Yeah, kind of.
Christine, any thoughts on this one?
I absolutely want to echo a lot of what Lou said. I think for family offices first, addressing this issue, and I think it just, the answer is it totally depends. They can be incredible advocates and amazing to work with, and they can provide very important capital, yet they can also require an enormous amount of hand-holding and require an enormous amount of time. And so I think that goes up front with what Lou was saying, requires an enormous amount of communication to make sure that they understand what they're getting involved with, who they're investing with. And there's so many different types of family offices, right? So they can be very sophisticated or not. Now, I will say in our particular case, I think that they've been very instrumental, because we're focused on investing in global companies that are expanding into Latin America or have a footprint in Latin America. And so we really, that cross-border fund where we have boots on the ground, yet we also can bring in international capital. And so for those family offices that understand the region or have a personal tie to the region, they can really provide that additional capital that could be a turning point. And they relate to what we're investing on a totally different level. You know, perhaps because they've lived in Latin America or have family there, they can understand our businesses and provide that strategic advice that perhaps some of our companies need, and they can open up doors in a different way. So that's one side. Now, in terms of international LPs, we do have Mexican pension funds on our cap table. And while I think it's extremely important that they started investing as asset class, we were the first venture fund that they'd ever invested in. The relationship took years to develop and to really get their entire investment committee and everyone comfortable with this asset class. And so that was a lot of effort on our side. But if you look at how ecosystems have been developed around the world, it is essential that those local institutional investors put money into the funds and into the venture funds that are also local. So I think that was an important step for us. And since their first investments in Ignia, they've continued to invest in venture, and it's opened up this asset class. And so that looks like there are long-term relationships that can be very beneficial, but they require an enormous amount of administrative back office work to comply with what they need for their international, the very complex structures, that need to work. But I think in the long term, it's definitely worth it.
Yep, interesting. And it goes to the point that Lou made about communication as well, right? Whether it's reporting or informal communication, it sounds like that's key. So very, very interesting. So we have actually about 10 minutes left. Time flies when you're having fun. But we have a question in the Q&A box that I wanted to put to the group before we run out of time, which is coming from Lisa Fedia from Stray Dog Capital. So she says, thank you, Christine and Cheryl, for bringing up the issue with representation among GPs. How would you recommend that a female-led Latino fund managers get their foot in the door? So maybe we start with Cheryl on this one and go to Christine and back through the batting order.
Thank you so much. At all levels, we want to be thought leaders of what we do, and we want to communicate what our value is into the ecosystem. And it doesn't, matter who you are. We speak to a lot of launching managers that are just leaving a very big branded firm and have to sort of reestablish a new brand and a new identity. And that goes straight into writing the short book about what's on your 2-page teaser, what's on your just being in the universe, but also being thoughtful about what you're speaking about and what you're writing about. So I think there's a branding and communication pattern that LPs are used to, and I find most LPs very research driven and very focused on their asset allocation, where the opportunities are. And so I think being very purposeful. I often try and draw a parallel to if you're hiring an asset manager, similar to hiring, picking the surgeon that will do heart surgery on your mother. You have to be very thoughtful about the qualifications of the person you're hiring. You want to see some demonstrated expertise in that person. And so however you want to demonstrate that expertise through your communications, there's web and conferences and things. So that's how I think building a brand, and then just being extremely responsive to the I think the universe is there to help you, and there's many organizations like Hispanic Heritage Foundation, which is trying to put people in the universe. So there's just a great number of support factors.
Yeah, first, it's awesome to see Lisa. She has an incredible fund. So I think one part of it is just building this network of other investors and in the Latinx community and talking about each other. So just like go check out Lisa's fund. But I think there's sort of two things that happen. First and foremost, we lead with our strengths. And so one is I always put forward my numbers first. I want to be known as an investor. I want to be known as a best VC fund that's focused on companies expanding into Latin America. And so you look at my numbers, look at my returns, and as Cheryl said, do all the research, diligence me, talk with the entrepreneurs that I've worked with, talk with other co-investors, right? And so that's the way to go. Yes, I happen to be a Latina fund manager as well. Now, how do I use that to my benefit? Building networks. I think this is a relationship-driven business. So who are the people that you can relate to, and that we're all looking for some sort of connection. So if there's that initial phone call, hopefully an in-person meeting soon, we can find things that we have in common that strengthens that relationship with a potential LP. So I think that's good. Now we've seen a number of initiatives come out, a lot more formal. You've seen Goldman Sachs, launch program. I mean, there are tons of little programs that are coming up. That is all a step moving in the right direction. So I think we have to apply, we have to work with those organizations. Now, I think we're beginning to see capital deployed It's been somewhat disappointing to see that initial step because their barriers to entry are so high. Like they'll say, like, when we'll invest in fund managers that are raising over $100 million fund. Well, how many first-time fund managers, female-led, do you know that are doing that, right? That have already done that, right? So I think it's, first steps, we have to applaud it, we have to work together, and we have to keep iterating, and hopefully they'll continue to be effective.
So Anthony, could I comment on that?
Yes, absolutely, Lou.
Yes,
Yep.
I really want to echo what Christine mentioned. The thing is like data driven. That's also the kind of technique we found super helpful when we talk with LP that present lots of the metrics and data, that's a solid number. And also it's very easy for LP to refer to really have evaluation on the GP, no matter you're a male GP or female GP. And as a specific female GP, I definitely share what Christine mentioned earlier, initial started fund as a female fund manager from the scratch, etc. There's lots of challenges. But for the past 2 years, also there's more female manager came out, and also there's also initiative association try to build up a community for the female GP to help out each other, including, talk with each other to get reference, get feedback, even share information about the conversation with LP, which institutional LP may have a designated capital allocate to a female minority emerging manager. That's very valuable information and will help your fundraising process be more efficiently. I'm part of Outraise. You guys probably heard about Outraise. So I think now we have having built up a really great community. We have co-home meeting. It's not only for fundraising, we also do kind of deal flow sharing, and also compare notes, even like small things like recommendation for back office admin, and also kind of successful experience sharing about how to better support company for exiting process. So I think that's a great community for especially emerging manager. So I think Lisa, I would highly recommend you to get involved with community like ours in the future.
Yeah, that's a great point. I think the fact that kind of you all operate in the private markets, relationships are at a premium. I think it's a little tougher to find out who's doing what, but once you do, I think that those relationships can become much deeper and much more valuable. So I really appreciate the question, Lisa. I appreciate the thoughtful responses from our panelists to all the questions. That unfortunately brings us to the end of our time. I had other questions that I wanted to raise, but we'll have to save them for next time. Thank you so much to everyone for participating. Really, I think this was a super valuable discussion, and look forward to continuing in next year. And hopefully we'll see you all sometime in between then.